All right, on this show, or if you follow me on Twitter or LinkedIn, you'll notice that we talk a lot about something called market structure, basically the mechanics of the market, how things like stocks and options and ETFs are kind of all tied together, and how that can move stocks and markets in ways that may not always make sense just from the headlines. And today, there is nearly $2 trillion worth of value in options expiring. Very few people understand all this better than Tim Quast, founder and president of Modern IR. He talks a lot about this on the Twitter as well. And maybe our first Mountain Time guest of the week, Tim. I don't know if you're still up or got up, but either way, we appreciate it. Talk to us at a very layman's terms, because it does get confusing, especially at this hour, how all this is sort of tied together and why we tend to get these outsized moves, particularly to the downside.
And it's good to see you, and thank you for your singular focus on market structure. You know, the people, geeks like me, who spend a lot of time in the quantitative data around market structure, really appreciate it. So, here's how we describe this to public companies and investors: that around options expirations, which don't occur on one day, they stretch from this week, Wednesday, Thursday, Friday. New options trade Monday, books get squared Tuesday. So there's a 5-day period where we tell investors in public companies, look, it's like a black hole. You have no idea what's on the other side of what may be tied to your equity. And so number one, it's a bad time to report results. We tell public companies, why do that? It's like trying to give a speech over a leaf blower. The things that will be far more impactful than your story are being reset, recalibrated, bet on during these periods of time, and you will see moves that are extraordinary, or can be, and that are not tied to rational factors. And then what happens is everybody roots around to try to figure out what in the information that a company reported, like Target or Walmart or Cisco, explains a dramatic decline in shareholder value. And it's not that. To me, the principal element that causes this today are exchange-traded funds and pre-market after-hours trading, where only a small part of the audience can trade. I'm against it. I can't fix it, but the fact that big blocks of ETF shares can be created and redeemed off-market by a handful of participants before the rest can participate is a key contributor. So here's what could happen.
Yeah.
This is the key. So say Morgan Stanley is an authorized participant for an ETF complex like BlackRock. And before the market opens, everybody wants out. Hedge funds want out of Target and a basket of consumer staple stocks. And so Morgan Stanley will go around, maybe even borrow a bunch of BlackRock ETF shares and return them to BlackRock and receive in the basket in exchange an equal value of shares, probably heavily weighted to Walmart and Target. Then, because that is not a customer transaction, you can't front run a customer's order, but this is Morgan Stanley operating on its own as an authorized participant, can turn around and buy puts on that whole basket and short the futures, which are expiring. And then all of that volume gets dumped at the open of the market, and these stocks get crushed. And it has nothing to do with rational thought. It is all about market structure.
Well, I appreciate the compliment, by the way, as a market geek myself. You kind of just described what is often the frustrating part of our job, which is trying to find a headline. We can't come on the air and say, well, I don't know. Right. But I'll look at the options desk or talk to my options guys and say, what's the gamma on this trade? Because I'll try to understand how big the swing might be. I'm going to dinner tonight, Tim, and let's say there's a restaurant that might go out tonight for dinner, and they have 10 of the nightly specials on offer. And there's 10 people in the restaurant. It should be fine. But there's 30 people from outside online who are going after it, maybe artificially, the same special. Is that kind of what's happening with ETFs, where it expands this access, maybe not artificially, to the same product? So you've got this huge swing, particularly on the downside, because it's all these extra people sort of coming into the restaurant at the same time.
Yes, the short answer is yes, and I can add some color to that. So I'm well acquainted with some of the larger hedge funds, and they tell me what they do. And two of the biggest told me that they make 2/3 of their returns on leveraged derivatives bets around earnings. So I might buy, no matter what, I just decide that the bet is going to be short on Target. And so then I'm going to borrow 8 to 9 times the money that my options bet is, and just overwhelm the supply side of the market. The stock market is like any market. It's got supply and demand, which are very measurable, by the way. We could see that there was no demand in Target ahead of reports, and its short volume jumped to 62% of its trading volume. So there are two factors that contribute. Exactly the same points you made with your restaurant reservations analogy, that there are things you can't see where there's a great deal more supply than demand, and it could be the reverse when things rise. And then the compounding.
Why is that,
effect,
Tim? Why is that allowed? Why is that allowed? I mean, I'm all for free markets. But you have these outsized multi-leveraged bets. You're getting retail investors getting their faces ripped off because there's some giant leveraged options bet they've never even heard of.
Well, and there are 3 words that tell you why. And it's from the SEC. The SEC decided that the purpose of the equity market is 3 words: a continuous auction market. Now, some of these things that begin before market hours then have to filter through the system. And here's what I mean by this. So the SEC decreed under Regulation National Market System that there will always be 100 shares of everything at the bid and the offer. Well, it's impossible. So market makers said to the SEC, we can't fulfill that obligation unless you exempt us from Regulation SHO Rule 203B2. Very jargon, weedy term, but what it means, that is the short locate rule. So market makers do not have to locate stock. They just manufacture it. And they will go on, they'll do that in whatever direction the market is moving. That is how Target's volume jumped from 42% short before they reported to 62% short in a day. Market makers will see the imbalance and feed it. If I want to short a stock, they'll manufacture stock to make it available to do that. And that is the problem. It is a flaw in market structure, but everybody should be aware of it. The beginning point for succeeding in markets that have complexity is a baseline understanding of how they work.
Well, listen, we got to go, Tim, but I think this has been a very enlightening interview for a lot of people, myself included. We're going to post it all over the place. I think people have to, when they invest, you got to understand these things are going on, and that's why we have things like Target falling 25% in a day on results that weren't great, but they weren't the end of the world. Tim Quast, a Modern IR, laying it all out. Tim, we appreciate it, buddy. Thank you very much.
Thank you.
All right, coming up.